Here's something that's always fascinated me. Farmers, who overwhelmingly vote Republican, will often tell you the same set of things: that government handouts are evil, that businesses that can't compete deserve to fail, that nobody owes you a safety net, and if you fall, you should pull yourself up by your own bootstraps. And yet, when crops fail, when commodity prices collapse, when a late frost wipes out the harvest, a flood drowns the fields, or tariffs destroy and close foreign markets, suddenly the tune changes. And you know what? I don't even mean this as an attack. Because when disaster strikes, the government does step in with crop insurance, with disaster relief, with price supports, with bailouts. The whole set of tools designed to keep farmers from going under. So here's the paradox. A lot of the very same people who argue against government handouts rely on them. Now, it would be easy to stop right there and just call it hypocrisy. But I think there's more going on. Because this isn't just about farmers. Look at corporate America. The banks, the ones that spend decades preaching free markets, efficiency, and competition. The ones that lobbied against regulation and government interference. And then, when the system shook in 2008, who got rescued? The banks, the very institutions that told us markets should decide winners and losers, were suddenly too big to fail. And again, it wasn't framed as hypocrisy. It wasn't even framed as a bailout in the same way. It was stabilizing the financial system. It was about protecting the economy. So I started to ask myself, how do we make sense of this? Why is it socially acceptable for some groups to rely on government intervention, but stigmatized for others? Why do we tolerate subsidies in agriculture, bailouts in banking, but sneer at welfare for individuals? Isn't it all in the end a social safety net? Just different versions of it? That's the thread I want to pull on today. Because once you start looking at it, you see the same pattern over and over. In principle, people say they don't want government help. But in practice, almost everybody benefits from it at some point. So the real question isn't, do we have a safety net? The real question is, who gets to use it? And what does it say about how we see ourselves as a society? That's what we're going to dive into today. Let's start with farmers. The stereotypical view goes something like this. Handouts are bad. If you can't compete, you fail. That's how free markets work. It's the rugged individualist myth that we like to tell ourselves, especially in rural America. You pull yourself up by your bootstraps. You work the land. And you succeed or fail on your own merits. But in practice, farming is one of the most subsidized industries in this entire country. And there's a reason for that. Farming is uniquely risky. Think about it. Almost no other business is at the mercy of so many uncontrollable forces. A late frost, a summer drought, a swarm of pests, a flood, a global price swing because of a trade war halfway around the world or started by Washington. All of these can wipe out not just the season's profit, but an entire livelihood. A family farm can be ruined overnight. And when that happens, the government doesn't shrug and say, well, that's capitalism. Instead, it steps in with crop insurance, with disaster relief, with price supports, with emergency loans. The goal isn't to make anyone rich. It's to stabilize the system, to prevent waves of bankruptcies that could ripple across rural communities, crash food production, and destabilize prices at the grocery store. And this isn't new either. Go back to the Great Depression and the Dust Bowl of the 1930s. Farmers were going under in droves. Land itself was failing, and food insecurity became a real national crisis. That's when the federal government stepped in with the first large-scale farm programs, price supports, soil conservation efforts, and later crop insurance. The idea wasn't charity. It was survival, for farmers and for the country. And yet, here's the paradox. Many of the same people who railed against government handouts in other contexts, say welfare for individuals or food stamps or housing assistance, are completely comfortable with farm subsidies. Why? Well, part of it's cultural. Farming is seen as noble, hard work, essential work. And there's truth in that. Every one of us relies on farmers to eat. But it's also about perception. Farmers don't see themselves as taking a handout. They see it as insurance, as protection against risks that no one person could possibly manage on their own. And most of the time, they don't even recognize it as a contradiction. To them, it's not hypocrisy. It's just practical, necessary, maybe even deserved. Because unlike a failing coffee shop or a struggling retail store, farming isn't exactly a business you can just close and walk away from. You can't pick up the soil and move it somewhere else. The land is tied to the family, the community, the way of life. So let's pause and really think about that. The social safety net isn't just some moral or ideological statement. It's a practical tool. It's there to keep society functioning when markets fail. And markets fail. And in the case of farming, it works. It keeps communities alive, prevents widespread hunger, and preserves the agricultural backbone of this country. Most people don't think about it because they don't interact directly with crop insurance or price supports. But they benefit indirectly. Food prices are more stable. Grocery store shelves stay stocked. Rural economies don't collapse every time there's a drought. The social shock of mass farm failures is avoided. In other words, everybody eats and the whole system keeps humming along. Now, let's swing to the other end of the spectrum, corporate America, and specifically the banking industry. Banks love to talk about the free markets, efficiency, competition, survival of the fittest. They tell you regulation kills innovation, that government interference makes the system weaker, that the market should be the ultimate judge of who wins and who loses. And yet, when a major bank is on the brink of failure, suddenly all that ideology gets thrown out the window. The government steps in. We even have a phrase for it. Too big to fail. Think back to 2008. The housing bubble burst. Risky mortgage-backed securities imploded. Suddenly, some of the biggest names on Wall Street were standing on the edge of the abyss. And some fell in. Lehman Brothers went bankrupt. Bear Stearns collapsed. A global financial meltdown followed. And the government, yes, the same government that was supposedly the problem, came rushing in with trillions of dollars in emergency funding. Taxpayers were on the hook. Ordinary people, many of whom were losing their jobs and their homes in the same crisis, were now also footing the bill to rescue the very institutions that had helped cause the collapse in the first place. And yet, listen to the way it was framed. This wasn't about favoritism. It wasn't about handouts. No. The narrative was that it was about systemic stability, about preventing the collapse of the entire economy, about making sure payrolls cleared, that credit kept flowing, and the machine kept running. And in a sense, that was true. If the banks had been allowed to fail, the fallout would have been catastrophic. Think Great Depression 2.0. But let's notice the framing. Farmers who get subsidies are labeled as dependent, as beneficiaries of government handouts. Banks that get bailed out, they're stabilizers of the economy. Same principle, different spin. And here's where the parallel to farming really clicks. Both farmers and banks rely on protective mechanisms to prevent catastrophic systemic failures. Farming subsidies to prevent food shortages and rural collapse. Banking bailouts to prevent financial collapse. Both are, in their own way, safety nets. But here's the difference. Scale, visibility, and perception. Scale because we're not talking about millions or billions with banks. We're talking about trillions. The sheer magnitude of financial bailouts dwarfs farm subsidies. Visibility, because most people never see the mechanisms of the financial system. They just feel its effects. When a bank is rescued, the headlines are abstract, full of jargon, liquidity injections, asset purchases, capital buffers. But when a farmer gets bailed out, it's concrete. There's a check, a subsidy, a program everyone can point to. And perception. Farmers are seen as people, neighbors, families, communities. Banks are seen as institutions. Farmers are deserving, hardworking, salt of the earth. Banks are too big to fail, faceless, necessary evils. And yet both rely on the government when the chips are down. That reveals something fascinating about ideology. People are okay with safety nets as long as they can be framed as serving some larger purpose. As long as the story isn't about individuals failing, but about society being protected. But let's be honest. If you strip away the framing, the principle is the same. A business should have gone under, but didn't, because the government made sure it didn't. Whether it's a family farm in Iowa or a skyscraper full of bankers in Manhattan, the safety net caught them. The only real difference is how we choose to tell the story. So, here's where it really gets fascinating. Both farmers and banks benefit from safety nets. Both rely on interventions when the market fails. But here's the kicker. There's cognitive dissonance built right into the way people talk about it. Take farmers. In principle, many of them argue against government handouts, against what they see as welfare or dependency. But when it comes to agriculture, subsidies, crop insurance, and disaster relief aren't viewed as handouts. They're seen as common sense. The logic is farming is too essential, too risky, too tied to the survival of communities and the food supply to just leave it up to chance. And so the principle of no handouts bends. Now look at the banks. They're the champions of free market ideology, competition, efficiency, creative destruction. These are the mantras. Weak players are supposed to fail. But when the entire financial system starts to wobble, suddenly those same voices are the first in line for trillion-dollar bailouts. And the interesting part is, in public conversation, it rarely gets framed as hypocrisy. Instead, it's dressed up as stability, national security, or the greater good. Why the difference in perception? A few things are going on. First, scale. Farmers are small and visible. You see subsidies, you know the programs. They get called out as government help. Banks operate at a scale that most people can't directly see. Complex financial plumbing, invisible connections, international ripple effects. Their safety net is abstract, so the framing sticks. Systemic stability. Second, power. Banks have lobbying clout, political connections, and media narratives on their side. Farmers have influence too, but in a different way, more cultural than financial. Third, narrative. Framing is tied to heritage, identity, survival. Banking is tied to progress, growth, the national economic power. Both groups get exceptions carved out for them, but the stories we tell about why are different. And here's the punchline. That flexibility isn't necessarily hypocrisy. It's human nature. People value principles like free markets and self-reliance, right up until those principles threaten survival. When the risk is existential, losing the farm, losing the global economy, ideology bends. And that's not weakness. That's exactly why we invented social safety nets in the first place. They're not about charity. They're about resilience. They're the guardrails that keep collapse from spreading. Now let's zoom in. Farmers and banks are just pieces of a much bigger puzzle. What we're really talking about is the social safety net, the invisible infrastructure that keeps society from unraveling when the unexpected happens. It's not just one program. It's a whole ecosystem. Social Security for retirees, unemployment insurance for workers between jobs, Medicare and Medicaid for health care access, SNAP and food stamps for families that need to eat, disaster relief when hurricanes, floods, and wildfires hit, crop insurance for farmers, and yes, even bank bailouts, when the financial system is on the edge of collapse. Now, is it perfect? No. Some people will go their entire lives never touching a single program. Others might lean on them heavily during tough seasons of their life. And then there are always debates about fraud, inefficiency, or fairness. But the big picture is this. These programs aren't random acts of charity. They are guardrails. They exist to prevent the kind of chaos that spills over from one person's misfortune into everyone's daily life. Think about it this way. When a factory closes and unemployment insurance cushions the blow, it's not just helping laid-off workers. It's helping the entire economy because those workers can still pay rent, buy groceries, and keep local businesses afloat. When Medicare keeps seniors out of medical bankruptcy, it stabilizes families across generations. When food assistance keeps kids from going hungry, it prevents a cycle of poverty that would have ripple effects for decades. And this is true even at the massive scale of finance. When the government stepped in during the 2008 financial crisis, nobody liked the bailouts, but without them, millions of people would have lost jobs, homes, and savings. The safety net caught not just the banks, but society itself. Here's the metaphor I like. Think of society as a spider web. Every strand is connected. You pull one strand too hard, whether it's a farmer going bankrupt, a worker losing their job, or a bank collapsing. The entire web trembles. And if enough strands snap, the whole structure falls apart. The safety net is what strengthens that web. It's not about propping up individuals forever. It's about keeping the structure intact so that everyone benefits. Farmers, bankers, teachers, factory workers, retirees. They're all tied into the same web. So the stronger the web, the more resilient we all are. Here's the question to chew on. What would happen if the social safety net disappeared tomorrow? Who would actually survive the next shock? Would farmers weather a drought or a flood without crop insurance or subsidies? Or would entire rural communities collapse in a single season? Would banks really hold steady through another financial crisis without taxpayer-backed guarantees? Or would the whole global economy seize up? Would ordinary people, families, retirees, workers, be able to withstand layoffs, medical emergencies, or recessions without some kind of lifeline? It's tempting to think that these protections are optional or luxuries society can argue over. But when you strip them away, you see just how fragile the system actually is. Markets, businesses, governments, and human communities aren't isolated islands. They're a network, interdependent, vulnerable, and deeply connected. When one piece breaks, the damage spreads. And that's the real point here. Safety nets exist not because people are weak or because industries are greedy, but because failure is contagious. One farm going under affects food supplies. One bank collapsing affects credit for millions. One family losing everything ripples through schools, neighborhoods, and communities. So, maybe the bigger question is, if safety nets keep society stable, why do we still treat them as if they're charity? Or worse, as if they're shameful? That's worth thinking about. Because ideology is easy when the system works. But when the shocks come, and they always do, when the cracks show, that's when we see whether we built a society that catches people or one that lets them fall. Now, if you found yourself nodding or shaking your head, let me know in the comments. I'd love to see how you feel about it. Because wrestling with these contradictions, that's how we actually start to understand the world. So here's the takeaway. Free markets are far more nuanced than we often admit. Farmers, who often say they believe in rugged individualism, rely on protection when weather, pests, or global prices push them to the brink. Banks, those temples of the free market rhetoric, depend on government rescue when the entire financial system starts to teeter. And in the middle of it all is the social safety net. Imperfect, sometimes controversial, often debated, but indispensable. It's the glue that keeps things from collapsing when the markets stumble. It's what lets societies bend without breaking. Most people benefit from some part of this structure, even if they don't realize it. For one person, it's Social Security keeping a parent out of poverty. For another, it's unemployment insurance that buys a few months to find work. For others, it's stable food prices because farmers aren't going bankrupt en masse. This is bigger than politics, bigger than ideology. It's about survival, ours as individuals, ours as communities, and ours as a society. So the next time someone says handouts are evil or bailouts are unfair, remember the social safety net isn't just charity, it's insurance. And like any other insurance, you may not think about it every day, but when disaster strikes, you'll be glad it's there.